It's been quite a crazy ride for the stock market over the past year, and in the last 3 months alone, the S&P 500 has hit 25 record closing highs. This is coming off the back of an already strong year where the market has rallied up over 13% since we started 2025. And if you dive into the depths of the April tariff chaos, remember that, stocks are now up over 30%. So this can now only mean one thing. It's time again to bring out the headlines and discuss a really interesting question. Is the stock market overvalued? And more importantly, what should we be doing as investors to get through the next few months? I'm going to run through the bear case and the bull case in the video, give you some interesting data points, and then I'll share my thoughts at the end, whether I think it's all over and we should hide in the basement. I mean, technically this is a basement, so I'm not really sure where else I would go. Anyway, let's go diving into some data, as there's a lot of charts that have seemed to have made their way back into the news. Here's the first one. I think this is the equivalent of the Ibiza final boss. Here on screen now is the Shiller cyclically adjusted price to earnings ratio chart. The title alone is enough to scare you, and it's hard enough to say on video. Now, here's what it's trying to show. At any point on this chart, we're given a number, and that number is our adjusted PE ratio of the S&P 500 from the previous 10 years. What this can tell us is basically how expensive the stock market is at any point, based on how much investors are willing to pay for the profits in a company. For example, let's say you have a business and it makes £100 million worth of profit in a year. If that business was on the stock market and its overall value, or market cap, if you want to use the fancy term, was £1 billion, then the PE ratio would be 10. That's the price or the value of the business, which is £1 billion, divided by the earnings of £100 million, giving you a ratio of 10. As you can see on screen, the stock market right now, at least if we look at the S&P 500, is trading at a CAPE ratio of 39.84. Looking back at the past, this looks quite high, as the average has been around 16 to 17 across all of history that Robert Shiller has collected. It also looks quite high when you consider that when this has spiked in the past, it's been followed by a significant crash in the stock market. 2 points really stand out for me here. You've got the dot-com crash, where we had all of the crazy excitement about the internet throughout the 1990s. And you've also got the Great Depression of the 1930s, which followed a huge speculative rise in the price of investments. Is this the start of a new bubble? Let me know what you think below. Leading on from this data point, let me show you another interesting chart that's also become more relevant in the news cycle. From JP Morgan's latest guide to the markets, have a look at this. Now, bearing in mind the Shiller CAPE chart that you just looked at, here's another bit of data that looks at using the PE ratio to show what future returns could look like. There's two charts here. The one on the left deals with 1 year of future returns, and the one on the right deals with 5-year future returns. Generally speaking, what you're looking at here is that if the stock market is trading with a high PE ratio, your future returns have tended to be lower, both on a 1 year time frame and a 5-year one. You can see this orange line here as your trend line, which shows how there is a relationship between future returns and the current PE ratio of the stock market. However, I would just say here that the 1 year chart is a lot more chaotic than the 5-year one. As you can see here on the 1 year chart, there have still been plenty of great years following high valuations. On the 5-year chart, I do think it's a lot more convincing, as it's showing us that you can't just have high valuations forever and that the market has to return to some kind of average and some kind of normality. Again, what you want to make of this is up to you. Now, personally, I think with all of this data, we need to be very careful, as there is one single thing which I'll call out later on the video that absolutely none of this data can show us, no matter what anyone says. Nonetheless though, it's certainly interesting to look at, and I can see why certain people can easily get scared. If the stock market is expensive, then surely it makes a lot of sense to not invest right now and just save your money until it gets cheaper. I think any normal person would react this way if you told them that the thing they want costs a lot right now, and if they just wait a while, then they can get it cheaper. Now, the final point I wanted to notch up for the bears is this one. As the stock market has gotten more expensive in a lot of people's eyes, it's also been getting more and more concentrated in just a few very big companies. The S&P 500 might have 500 companies inside of it, but the vast majority of them hardly make any difference at all to your returns. And most of your money is being made at a moment from just a handful of stocks. Check this out on screen now. Here's some of the biggest names in the S&P 500. And in this column here, we have the weight of the stock. Basically, the larger the company, the larger its weight is inside the index. What this shows is that just a handful of big companies are the ones making the market. For example, the top 10 stocks here in the S&P 500 now make up close to 40% of the entire weight. For some perspective, have a look here on a long-term graph so you can picture it. The weight or size of the top 10 stocks in the S&P 500 have never been higher than they are now. Also, even if you zoom into the last 10 years, you can see how this red line has been trending upwards as more and more investors' cash has been poured into a few of the big winners. Now, although this has been great in most recent years, with these stocks delivering huge amounts in gains, the issue now becomes whether they can continue to do this. With more concentration comes more risk, and the risk is that in the future, these companies fail to deliver what a lot of people are expecting them to do. The boom in prices from the excitement around artificial intelligence is certainly a big factor driving higher prices at the moment, and virtually every big player is claiming to be using it or developing their own version of whatever they think it is. The big question though is, will all of this spending actually generate those returns, or are we all about to see a monumentally sized AI bubble come to a screeching halt? Let's look at the bull case just before we wrap things up. Okay, time to counter some of those points and make a bull case for the markets at the moment. Firstly, let me go back to the Shiller-Cape ratio. This chart keeps getting wheeled out by all the doomers on YouTube and various parts of the media who use it as some kind of golden bullet. Yes, the ratio right now is higher than a historic average. And at first glance, you might assume that you can somehow predict a market crash using this. However, there are lots of things that this doesn't take into account. First off, you cannot compare the stock market in 2025 to the one of 1900, 1930, 1970, or even 2000. Going back to a world still using horses and carts to move stuff around and taking points of data from it to try and guide you to a better investing future is just total nonsense. The companies that make up the stock market are completely different now compared to the ones that made it up many decades ago. Let's go back just 35 years ago to 1990. Here's what the S&P 500 looked like then. A completely different list in the top 10. The only technology company here was IBM, which today is still around but sits more than 30 places down. At the top you have energy company Exxon, and some of the other names are General Electric, Johnson & Johnson, and even Coca-Cola. In fifth place, this should show you just how the world has changed, is the tobacco company Philip Morris. In just 35 years, it's been relegated almost as many positions in the S&P 500. How many people would have said back in 1990 that in just a few decades, this list would be made up from companies that either don't even exist now or were a shell of what they were to become? Anyway, the point here is that it's not useful to compare the PE ratio of companies from the 1990s to the ones we have today, as it's like comparing apples with oranges. Generally, technology companies have a higher PE ratio because they can generate more profit and can also scale way faster than any traditional company from other sectors that existed in the past. If a company keeps delivering their growth and keeps delivering the profits, then who's to say that it shouldn't have a high ratio? Next up, leading on from that point, are investors just getting too excited at the moment and paying whatever price is demanded for the popular stocks of the day? Looking at some of the most recent company earnings data, I think we get shown a very different story to the one that some people like to spin. From the most recent company earnings data we have, that's everything reported in the last 3 months, 82% of those companies that have reported actually beat their profit earnings estimates. What's interesting to note is that is above the 5-year average of 79% and way above the 10-year average of 75%. Almost every sector is doing well, but leading the way is the technology sector still, and the 6 mega cap tech companies contributed to almost half of all of the earnings growth for the quarter. So just to summarize this point, the big companies that are also priced quite highly are also the ones making the most money. It's not that their price is going up and their profits are going down. These companies are making lots of money, still growing fast, and clearly getting the attention of lots of investors along the way. If we were in some kind of bubble, you would expect to see prices going up for stocks, but the profits not being delivered. For example, when we look back during the dot-com bubble, or even during the post-COVID boom, there were loads of companies coming to the stock market that had basically no profits at all. Take a look here. Here's the amount of new companies coming to the stock market every year since the year 2000. The standout year was 2021 with more than 1,000 IPOs. Many of those companies have gone to zero now or worth far less than they were valued at when all of the excitement was around investing. In 2025 so far, there's been 254 IPOs. It's not an incredible year by any means. There's been many with many more than that, but it's also not a bad year. It's just somewhere in the middle. Now, I don't think alone this is somehow proof that there's no bubble in the stock market. I just think that it's an interesting factor and something worth reflecting on. If we look at the actual earnings of companies we currently have, here's what we get now. In the JP Morgan report that I was using earlier, this page shows us how companies in the S&P 500 are growing their earnings, or in other words, are they making more profit than they were before? The answer is yes. On the right here, I think this is the best example of this. From the date of this chart, we can see that in 2002, the average profit margin from companies in the S&P 500 was just under 8%. Today in 2025, it's more than 13%. That's an increase of more than 60%. So as an investor, I would definitely expect to pay more now than I was in 2002 if I'm making all of this extra cash. Just think about this too. Today, in 2025, Nvidia is the largest company on the stock market. It's grown massively over the past few years and it's taken the top spot from Apple, which held for a long, long time. Nvidia makes 75% gross profit, and even after all of their expenses, they have a net profit margin of more than 55%. So for every $100 of revenue they get, they're making $55 in profit. Those kinds of numbers were just unheard of for a large company a few decades ago. For example, compare that to a company like ExxonMobil, who are in the oil and gas industry. They're making a net profit of less than 10%. It would be insane to suggest that the stock market should be cheaper now than it was in the past, or that we should be paying less money for the companies that are around today. There is just no comparison at all, and the technology that exists today is just unimaginable from the past. On that point, let me address something I mentioned earlier. I think this is really important. No amount of research, scanning financial stats, or reading the stars can tell you anything at all about the future. And this applies just as much to the stock market as anything else in life. If it was easy to research an investment and choose a stock based on financial statements and past data, all of that would be instantly priced into the market. If there were any way to guarantee high returns or make money easily, it would already be done, and all of that risk would be priced in already. Investing carries risk because we have no idea about the future. Everything from this moment on is completely unknowable. Even the best economists, scientists, and financial nerds cannot predict with any level of reliability things like GDP, inflation, what interest rates will be, and they certainly can't tell you what the stock price of your favorite investment is going to be in 5 years from now. You cannot research the future. I should get that printed on my forehead just to remind people of my own videos. On that note, here's my own opinion for what it's worth, and here's what I'm doing. As I just said, there is no way to know the future. There's no way to know if the price you're paying today for an investment is a good one or a bad one. You can go back and look at all of the data you like, and you can take your pick of whatever supports your ideas, but no matter what you think, you cannot predict the future. Now, I use that as my default position when I invest, so I don't assume that I know better than the market at any given point. For example, I have no idea if the current level of concentration in the stock market in just a few companies is a good or a bad thing. It just is. The market has decided this by all the buying and selling that goes on every single day. The price is determined solely by the supply and demand out there, by all of the players at any moment. Who's to say that there is a right amount of concentration or a wrong amount? Surely, as an investor, you just want to invest in the best companies and take advantage of the ones that are doing well. Generally speaking, capitalism is a winner-takes-all business model. For example, you might start off with 100 corner shops all selling fruit and vegetables, but over the years you end up with 2 or 3 huge supermarket chains. Less businesses, more concentration, but overall, a more profitable business model. Personally, I don't spend too much time worrying about whether the stock market is overvalued or not. If I did, I'd have to decide when the right time was. I'd have to decide based on the overall price, the PE ratio, the overall sentiment of the market, or whatever else really I wanted to pick. How would I know that I'm buying in at a good time? The answer is that I wouldn't unless I knew the future, and as I said before, nobody knows the future. Now, this doesn't mean that the stock market can't fall or crash, or that we end up in a monumental AI bubble. But this is the price of investing our money. There is risk there and there are returns because nobody knows what's going to happen. Even the best professional investors who actively pick investments for a living will never seriously suggest that you can jump in and out and get the timings right. They'll always say that you should remain invested at all times and continue to think long term. This is ultimately exactly what I do, and I put all of my money where my mouth is, showing you regular monthly updates how I'm actually getting on. However, that's all just my opinion. What I'm really interested in is what you think about too. Let me know in the comment section below. Do you think we're in some kind of bubble and are you waiting for things out and seeing how they want to go? Anyway, I'll see you in the next video. As always, happy investing.